It's a very simple pitch. Whether you're a commerce student, graduation student, whatever student, you learned the formula of compounding. Okay, compound interest is V, which is value, is equal to P, principal, into bracket 1 plus R to the power of N. Every guy in his life focuses on R, which is what is the rate of return. What you do not realize, true compounding happens because of the factor of N, not because of the factor of R. If you want to create wealth, okay, you have to focus on how many years you spend in the market, not what return you made in a fund in the first 3 installments of your SIP or in the first 3 years.
Folks, welcome to Paisa. I'm your host Anupam Gupta, B50 on Twitter, and on today's episode, it's great to have UTI AMC back. I'm talking with Peshotan Dastoor, head of sales, about how mutual funds are doing, the latest trends, the future of mutual funds, and much more. So, folks, we had UTI on our show when Vetri was here back in April of this year, and so I'm really glad, really thrilled to have our current guest, Peshotan Dastoor, head of sales. Pesi, welcome to Paisa. Thank you so much for doing this for our listeners.
Thank you so much, Anupam. I'm really delighted to be here.
Fantastic. Pesi, we've had CEOs, we've had CIOs, we've had fund managers, chief of business for mutual funds, and first time I've got a head of sales. Okay, so I'm really thrilled to have you. First, explain to our audience, what does a head of sales do at a mutual fund?
So before I get there, Anupam, firstly, thanks for giving me the privilege to be the first head of sales to be on the show.
Yeah.
So, we'll talk about head of sales later. First, you must understand what the salesman in a mutual fund do. If you've seen a magic show, Anupam, the magician comes on stage with a magic wand, with a hat. The salesman's life is very difficult because he has no wand, no hat to pull out tricks from. Because essentially a sales guy does not create anything. He is not the guy who manages the money. It's the fund manager. It's the operations team that does service delivery to a customer. The accountant does the NAV every day. But the sales guy is the voice of the firm and has to create magic by bringing in all of the products and services that you have, to offer to a customer without doing it himself.
Wow.
Think of a doctor. The doctor not only prescribes, advises, but also executes himself. In this case, imagine going and meeting someone who's a representative of the doctor, but not the doctor.
Yeah.
So that's the starting point of thinking of what a salesman does. Okay. The business has evolved. It is B2B and B2C. Primarily, a salesman engages with distributors and advisors that work with mutual funds. We also deal with end consumers, whether it's individuals, corporates, institutions, trusts, and the likes.
Yeah.
Okay. As head of sales, probably 85% of my job is to be a salesman.
Oh,
okay. The 15%, I'd say 5 out of that is where I spend time on strategy, which evolves to say which products to launch, what's a trend that you can try and read before time, which markets to go to, where do you want to set up a new footprint for your organization. And the remaining 10% has to be in execution along with the 85, which is core to the job and truly core to my heart, being a salesman.
And this is not your first job as sales in a mutual fund. I mean, you've seen this, you've done this. What's your career been like?
I started young. I started at age 20, immediately after graduation. Because of the internships I did during graduation, I started my career with a bank, Bank of Nova Scotia. Spent a short stint there with them. Joined ING 96. Did about 12 years with ING. 13 years with Franklin Templeton.
Ah, nice.
And since May of 21, I've been with UTI Mutual Fund. So of the 30 years that have gone by, the first 10 years was a banker, and the last 20 have been in the mutual fund industry. Worked with Canadians, worked with Europeans, worked with Americans. I said, now it's time to work with the Indians.
Nice. So when was the first time you actually bought a mutual fund or started an SIP?
So it's an unfortunate story.
Okay.
Because I started working in 1994. And no one taught me, Anupam, at that point of time to say what the power of compounding of 2,000 rupees in a salary of 4,000 could do if I had invested for the last 30 years.
Wow, yeah. Very
So what
insane.
was I doing? I was putting that 2,000 that I saved every month in a bank fixed deposit, because as an employee, I got 1% extra. And for that 1%, I used to diligently, I not even call it invest, save in that fixed deposit. Life changed about 98, 99 when I got involved in the private bank of ING.
Well, that was a
And
very good product from what I remember.
That's
ING
true.
private banking those days was among the most better ones, if I recall correctly. Yeah?
And we had brought in many products which were otherwise inaccessible to HNI customers, meant for those solutions.
Yeah.
That's the time I did my first mutual fund around 99. I started probably my first SIP somewhere around
Don't tell me
2001.
those tech mutual funds, those 2 or 3.
Oh, I did all of those too.
Yes,
You know,
I did them. Yeah.
I did that
Something
because
new millennium, something I don't know what.
absolutely.
Yeah.
So I saw a lot of 10 rupee NAVs go down to even below 2 rupees and, all of those. But then in life, like everything else, you learn when you get it wrong many times before you get it right.
Amazing. Yeah. So I'm sure that you've got enough SIPs going now, and now it's become a habit.
Not only that, but for any and everyone I meet, including my own household. So just as an example, my daughter did an internship for a few months, and whatever salary she got parked, and that's where the SIP is going. I said, nothing doing. You ain't touching this money, because I can't allow you to make the same mistake I made,
See that?
not starting early.
That's how it's supposed to work, right? The same mistakes you made should not be made now.
Exactly.
Now let's take a step back and look at the industry. Okay, now it's kind of very weird that your personal experience also tracks with how the industry has evolved, because UTI, I think, was the first mutual fund that got set up in 1963, if I have the dates correct.
Absolutely.
And then came those PSU mutual funds, I think in the 80s somewhere, and then of course everything opened up in the 90s. But here we are in 2024, okay, if you just look at, I don't know, the last decade, okay, there's 4 years of COVID, of course, let's go 6 years beyond that. How has the industry evolved in this last decade?
I've been in the industry for 20 years, and therefore I've seen a fair bit of evolution. Okay. And let's just start with the top line numbers. An industry which was probably less than 1 lakh crores, in that had 85% of its money come from corporate and institutions, and very few retail investors actually even understood what the power of this industry is. And this I'm not talking about 1960s. I'm talking about as recent as early 2000. Okay.
Wow, 24 years ago, roughly 20-30 years ago, it was just
20,
1 lakh
it was just
crore.
1 lakh crores.
Wow.
Okay. That was all this industry is. Today it stands at 60 lakh crores. Okay. Then it was all about, certain types of products. But I think the attraction to individuals and retail investors particularly came because the platform gave a great access to capital markets, diversified and variety of products that they were able to, participate and gain from the underlying markets. And that's where over a period of time, this popularity, accessibility is the most important thing. And advice. And I think, there are two big pillars the way I look at it. One, what the regulator did, and two is what the industry did. Okay. The regulator has made mutual fund the common man's platform for investing in capital markets. Variety of changes, from entry loads to bringing costs down to standardizing products to best practices, whether it's in distribution, sales or fund management. But as far as the industry goes, I think this is a AAA industry. Okay. First A is awareness. Second A is access. And the third A is advice. Okay. And in the more recent times, particularly since the last probably 7-8 years, the Mutual Fund Sahi Hai campaign has immensely helped bring that awareness. The advent of technology and adoption for accessing mutual funds has changed the game from where investors are coming. On the advice or the distribution part, okay, I think a lot can still be done as far as gaining popularity in this industry. But it's been a great journey, and I would still if I had to ask God for one thing, is let the year be 2024, but make me back 20 years and do no change. I want to be in this industry probably for another 40 years of working life.
Nice, yeah. How have retail investors evolved, right? I mean, you look at you, or even, when I think my first mutual fund also would have been in that internet boom and all that. There was no thinking. Flavor of the day. क्या आया? अच्छा नहीं इंटरनेट आया डाल दिया पैसा कुछ उसमें 500, 100, whatever. SIP तो I don't even think existed. And distributor would come in, have this nice bunch of forms, or at least one form, whatever. Cancel check दो ये दो पता नहीं क्या. You remember that. I'm pretty sure you do. Because
Absolutely.
that's how all of us came in. Fast forward to today. How has the retail investor evolution been?
So, Anupam, I'd say some things have changed and some things haven't.
Okay. Yeah.
So today, the biggest attraction today also to retail investors is return and nothing else. That hasn't changed in time. Wherever there is an opportunity of a return, you'll see like bees to a flower, they'll all be, assembling over there. So that hasn't changed. But clearly, I think there has been better method to the madness that is now being applied. There is better advice that is being delivered. There is better accessibility and most importantly, financial literacy. So if one today looks at the industry, this industry has got about 20 crore folios, about 8 crore SIPs running, and close to about 6 crore or 5 crore unique investors. 5 crore unique investors is the number. Okay. Now, the way to benchmark this is to say, don't look at the population of India.
Obviously.
Because there are, infants and non-adults and all of that. But the addressable market, in my opinion, is anyone who files an income tax return. Because that person has got an Aadhaar card, that person has got a PAN card, that person has or had income. May or may not be paying taxes, but still is filing an income tax return. And if that number has reached close to about 20 crores, imagine this industry today is 60 lakh crores with 5 crore investors. What the potential for, investments and penetration lies ahead of this industry. This evolution has been great, and there is a lot more that people can really take the use and benefit from mutual funds.
Okay, basically, what are distributors saying these days? When you go out and meet them, I mean, is it a great place to be in, great times to live in, or is their mood different? How's the mood on the ground?
The mood is simply fantastic, buoyant, fabulous, and every other word that you can use to describe this feeling. And I think, Anupam, this is clearly an outcome of, again, returns. Returns makes an happy investor. Happy investors make very comfortable advisors. But we've seen enough of these cycles and markets for us to worry. I can't predict the markets. I don't know where the markets will go. But all I can tell you is that for distributors, both ends of the spectrum, whether it is exuberance on return side or panic as far as fear goes, are the most difficult times that they should be careful about. Distributors have been overactive in painful, pessimistic and bear markets. I don't see them exhibiting the same level of, hand-holding that they need to do in optimistic and bullish times.
Very interesting, yeah.
And that's what worries me, because those are times when portfolio asset allocations go haywire, where portfolio allocations within an asset class, but whether it's large cap, mid cap, small cap, whether it's fixed income shifting to hybrids, these kind of risk on behavior, loading risk, is what the distributor / advisor needs to focus on in these exuberant times. Just as much as you would make an effort to keep an investor invested in bad times, you need to make sure they are staying the course for what was their plan. And I don't see that, unfortunately, happening enough. everyone is happy in the party, but the smart guy will prepare his customer for making sure their plan is on course and not being led by markets alone.
Very interesting. Oh, tell me one thing. There are two major changes that happened in the industry, I think, in the last, 2007-8. One was when entry load went away, and the second was when direct schemes came in. Okay, both of them kind of hit the distributor in certain ways, and to its credit, the distribution industry is thriving. I've had NJ on my show, and NJ is among, if not the largest, I think they are among the largest in standalone distributors for mutual funds, and they've done a fantastic job.
Absolutely fabulous.
You think that self-awareness or the self-learning that comes, thanks to podcasts like this and stuff on YouTube, is helping in changing investor behavior? Or like you said, it doesn't matter whether I'm coming in directly or through a distributor, I'm still chasing returns. So you think that somewhere, something needs to change here?
So, of course, things need to change. Why I like these bull markets is because they bring in a lot of investors, which will never happen in a bear market. Why I like all of these investors to see bad times is because that's when you will really learn how investing and making money over long periods of time works out in your favor. Okay. Since 2000 and probably 13, which is now almost 11 years running, India's been in a bull market phase. So you've not really been tested as an investor. Okay, even in the year 2020, it was just a blip before you could realize, and there were greater priorities of managing family and life rather than just money. And therefore, for me, to say that just as you have baby boomer phase, this decade has seen a very large expansion of the investor base. I just wish that they learn in good times, don't have to face bad times to learn about what true investing is. We've had regulatory changes. Like you mentioned, you called out two of them. We've seen series of regulatory changes. I think another big one was where product categorization got created and you had a lot of mergers of funds into each category. That was another big one. Taking cost perspectives, SEBI came out with a decreasing expense on an increasing asset base, again to the benefit of investors. But I must give credit to the distribution industry for the fact that the people that stuck the course from an environment of 2.5% to 3% upfront commissions to trail, and that trail being declining on incremental sales. But clearly the vision that SEBI carried was scale in this industry is what you have to play for. And distributors, including NG and many others that played that out well, have seen the benefit, but from purely providing great service and advice to investors in that journey.
And the investors who stayed the course also have benefited from the LEVs. What is happening in the smaller town and city? That there's this categorization, I think it's called B15 or below, I don't know what, but what's happening there? I mean, this is a part of India that has existed, but investing behaviors were not as widespread as they are today, as say 20 years ago. So what's happening there?
Again, I'll go back to where I began, the AAA, which is awareness. So the mutual fund industry has done a fantastic job with the mutual fund Sahi Hai campaign. You go anywhere in the world, if you shout, including if you went to the hills of Matharan and shouted mutual fund, you'll get an answer back in echo which says Sahi Hai.
Okay.
Right? Second, access, like I said. So it doesn't matter whether UTI or anyone else open their office in the smallest town, as long as there is data that gets delivered there, he's able to access it. So today you can take this industry and cut it into different thought processes about where the asset is coming from. While till recently we used to look at the top 30 cities, not 15. It was earlier 15, then it became 30, different from the rest of India or beyond the top 30. Even today, 82% of the assets come from the top 30 cities. But that's no benchmark to lay any, conclusion from, because all your corporate money that invests in mutual funds sits in the top 8 cities rather than even 30. The real metric would be to look at folios and to look at SIPs and where the new SIPs are coming. So you'll be surprised to know, Anupam, that today 58% of the new SIPs come from beyond the top 30 cities in the country.
58%.
58% of the new SIPs.
Huge.
Okay. As of today, 51% of the folios are held by individuals and other entities, but 51% of the folios are from beyond the top 30 cities in the country. And that's the true power of what mutual funds and access has done in this. So do not lose or not give credit to markets, because the enthusiasm finally comes from seeing what markets have returned and brought in investors along with it. But I think that's where the statistics stand. Do I believe that every person in Bandra West or Borivali East has invested within the city of Mumbai itself? The answer is an emphatic no. But there is an equal opportunity across this country, undoubtedly.
Okay, Pesi, now that we've spoken about the industry in the first half, cities and how the product has evolved, I want to understand what's happening today, right? Because we've had a great run on the markets. I think we've had 8 consecutive years of positive returns, something that this market hasn't seen for quite some time. The flows are looking very interesting. Where is the money going? Okay, we know that there is about $2 billion out of SIP coming in. Flows are nice, everything is nice. But when you look at this chart, and I think somebody had posted it or it came in some newspaper as to where exactly the money is going, it's going in sectoral and thematic. Hot areas. Okay, obviously they're hot because that's what has performed. You've got certain sectors which are up like some 4 times, 40 times, 50 times, pata nahi kya. Okay. Is this, what do you think about this? The fact that these places are, these funds, okay, which obviously are doing a very good job at whatever they're doing. Is this performance chasing in some way by retail investors? What's your view on this?
So, Anupam, I'll take, one step back and then come to this question. SEBI categorized products, and in a category, a fund house can have one. So I can have one large cap fund, one mid cap fund, one small cap fund. But in sectoral and thematic, there is no limit. Okay. So I can have a thematic fund for manufacturing, or I could have a sectoral fund for auto, and then a sectoral fund for pharma. Now, if I am an asset management company that has got populated products in every space that SEBI defines, and I do believe and see an opportunity in a particular sleeve of the market, okay, and that's where you're seeing a large number of NFOs playing out at this point of time, which classify under the sectoral and thematic space. Okay. How big is it? So today, about, 68 to 70,000 crores is the gross sales in equity funds alone in a month. Okay.
Okay, cool.
40% of that, which is 27,000 crores, is actually going into sectoral funds.
40%?
40% of that.
That's a lot of money.
That's crazy amounts of money. But a lot of that is also attributed to many NFOs that have happened in recent times. And those NFOs, and the attraction of 10 rupees, garnering some amount of big collections.
10 rupees still plays,
for whatever fancy, it does.
Whatever works,
At some time back, but you have to look at it in relation to, what. So you compare today how much is selling to what is the stock that you have from the past.
Correct.
So on an AUM basis, sectoral funds are 14% of the entire AUM in equity funds. But today they sell 26% of new sales that are happening. Okay.
That makes sense. Okay.
Now, the other thing is, sometime back, the fancy was small cap funds. Correct? That's dropped off, Small cap constitutes about 10% of assets within equity. But today, when it has dropped off, they only contribute 7% of the gross sales happening within equity as an asset class.
So that's the swing.
That's the swing that is happening along with NFOs and things like that. Now, what causes this? Availability of products, ideas, new themes, and repeatedly, as I said, underlying returns that the market or the segment delivers.
Yeah.
So that's where mid cap, small cap, played the fancy for most parts of 23. Today it is something else. But to be seen in the right context, not in absolute and only numbers, that what proportion of stock as well as new assets does it contribute?
Yeah. So I want to sum that up as some excesses are there, but in the broader context of things, it's still okay.
Absolutely.
I think more importantly, to go back to the point you made in the first half, probably the advisors need to do slightly better job of saying that, listen, asset allocation ka bhi thoda dekho, like get your asset allocation right. Just chasing returns is really not going to do a lot. Okay, cool. SIPs. Okay, it's like this rocket chart. Like it just goes. Like I remember when I was learning geometry in school, there used to be this right angle, that right angle thing, right? That triangle thing or whatever, and the hypotenuse is just like that. That's it. It's just going like that. What's happening? Will it continue? Do you think a lot of people are saying this is nothing? This is like USA 1980 where money just kept on coming and coming. What's your view on that?
Firstly, I agree and I disagree. I agree to the fact that this is not a short-term wave and this is not going to reverse very easily. Okay, because please understand, and India is the only country in the world. I've seen business operations happening in many, many countries across Europe, Asia, Americas. Granularity of savings that India channelizes into investments through a vehicle of SIP is a purely Indian phenomenon. In many other countries, it happens through compulsory deductions from your salary, and that's how it feeds through the equivalent of our provident fund. Yeah. But this is voluntary investments being done in small bits by investors is a purely India phenomenon. And this goes back to our DNA, where India is a country of savers. Thankfully, it's shifting to a country of investors. Do I believe that this trend will continue? The answer is an emphatic yes. Do I believe that it will continue with the same intensity for the rest of our life? Probably not. We are, victims of the market and beneficiaries of the market. And in bad times, we will see some of this slowing down. But do I believe that, there will be a big reversal wave that is going to likely to exist and, this is going to be a chapter that will not continue? I don't think so. This thing is going to continue to grow. Yeah. Now, the impact of that in terms of flows and those flows on the markets, I think you have to also look at the context of the market cap, the GDP to market cap to GDP ratios. Yeah. And look at the SIP flows in that context, not on a standalone basis. So, in many quarters, SIP flows have increased by, as much as 1,000 to 1,500 crores. And imagine where the average is 2,000 rupees, going up by 2,000 crores in like 4 months is a phenomenal movement that is happening at the back. Yeah. It's the right way for investors to participate. I get very pained by one area, which is the SIP stoppages. Yeah. So, while the industry sees a very large registration of SIPs, probably the first, second installment coming through, we also see a tendency, and that's the evil of access, that it's very easy to go and click a button and say, stop my SIP.
What's the drop-off looking like?
There have been months where for every 100 new SIPs came in, as many as 75 old SIPs shut down.
Wow,
okay,
that's
for incremental SIPs.
Insane distortion.
It is absolutely insane distortion. Yeah. In terms of in long-term thinking, I still like the idea because there are those many investors coming in new. But from a wealth creation perspective, is it a great habit? The answer is no. Yeah. So it's like saying, hey, listen, you're never going to learn how to swim if you don't enter the pool, okay? And you entered the pool and you got out of the pool and you entered the pool and you got out of the pool. But instead of spending a few hours before you're able to splash around, that's the thing that, I'm hoping that people that come back and exit, learn, and you might get many times wrong before you'll get it right.
Yeah. So make a pitch here. I want our audience to understand. Like, there might be a few people who are watching this, listening to this, hearing this, and they get a feeling that I should stop my SIP. What's your pitch to them that do not stop the SIP?
It's a very simple pitch. Whether you're a commerce student, graduation student, whatever student, you learned the formula of compounding. Okay, compound interest is V, which is value, is equal to P, principal, into bracket 1 plus R to the power of N.
Correct.
Every guy in his life focuses on R, which is what is the rate of return. What you do not realize, true compounding happens because of the factor of N, not because of the factor of R. Okay. If you want to create wealth, okay, you have to focus on how many years you spend in the market, not what return you made in a fund in the first 3 installments of your SIP or in the first 3 years. So let me give a simple perspective, on this one, Anurag, and I think this is an extremely powerful, I hope, a message that gets delivered to people.
Please, yeah.
So, often people ask me which is the most important investing segment. And I always believe it's the grandparents.
Okay.
Let me give you a perspective. A 10,000 rupee SIP started when a child is born by a grandparent and continued till the age of 60 with an expected rate of return of 13%, which is reasonable, translates into 215 crores.
That's just compounding.
That's compounding.
That's just math.
That's just math.
Yeah. And even if you bring down 13 to even 10,
that's just math. That's as simple as it is.
Yeah.
So every time I meet an elderly person and he says, what should I do with my money? I've got this much corpus. I say, first of all, blame your grandfather or grandmother. Okay, because they should have done 2 things. 1, started the SIP for you. And 2, like they taught you, value systems in life, pick this one up and said, beta, jhoot mat bolna, beta, chori mat karna, beta, bado ka adar karna, beta, SIP mat rukna.
Okay.
As a value system in your life. Because only then would you create this kind of wealth. And to understand the power of N in this equation, if a guy begins a 10,000 rupee SIP at age 30 instead of age 0, continues for 30 years instead of 60, same market return of 13%, you know what corpus he'll end up with?
What's the number?
5 crores. It's under 5 crores.
Man.
5
Crazy.
versus 215 crores. That is the power of N. So for most investors, they're always, enthused by R. It's completely a fallacy. Okay. That's how money is made and wealth is created.
Man, that is something. I mean, I know that I haven't stopped an SIP so far and I don't plan to. But yeah, folks, don't. I mean, either have a very valid reason. I don't know what your reason is, but if you're just redeeming it because the returns aren't good enough, I don't know what to say to that. Let's move. I think I can do an entire episode on just what you said about power of compounding because it's so powerful.
Oh, absolutely.
P 1 plus R N. I mean, Excel khol ke kar lo yaar. Okay. Vithi, what's happening in mutual funds now going forward? Right now, here we are in 2024. I think that, as you said, regulators done a great job. Categories are there, debt is there, equity is there. Within each of them, you've got enough area to play with, enough products to play with as per your financial objectives, as per your financial plan, whatever. Where do you see this industry now going forward from here? Whether it is products or whether anything else?
Sure. So I think, in terms of products, there will be a lot more innovation. Although while there are categories defined and like I've repeated earlier, you can have only one product. So the question is, is there a better way for me to extract value from the market than a actively managed open-ended fund that is slotted into a particular product category and I'm not able to do that over there. Okay. Innovation, I believe, will happen in 2 broad spaces. One is passives. passives are big in the world. I'd say they are in infancy as far as India goes. Okay. Within passives, there are two types of passives. People, where the minute you say passive, they look at it and say, what's the big deal? It's
Boring
a
product.
Nifty, it's a Sensex and nothing beyond. But that's where the evolution of passives will happen, where it's nothing. It sounds very fancy when you call it smart beta passives. But essentially, you apply certain factors or basis of which you are able to create a portfolio or an index, and a manufacturer like us will just replicate that index. So I think, firstly, let's talk about product evolution. Okay. SEBI, like I said earlier, has defined categories, and in a category, I can have a product. So I can have one large cap, mid cap, multi cap, flexi cap fund. But there are many ways in which you'll be able to extract value from the market than actively managed products. In that, I think the passives and the biggest innovation will happen in the passive space. Our normal understanding of passives is replicating an index, and it could be a broad-based large cap or a mid-cap index. But the evolution that is happening in passive space is, the term sounds fancy, smart beta, but it's a very simple thought which says you apply certain factors, okay? An index provider runs these algorithms to come up with a portfolio basis certain principles. These principles could be momentum, these principles could be volatility, these principles could be alpha.
Yeah.
And basis those factors come out with an index. That index is what a manufacturer like me replicates and delivers into or from a product. And you can see I can have an 80% large cap portfolio versus a large cap fund, and the two products will behave and their composition will be completely different from each other. Yeah. What makes a difference is that the extent at which a stock is held in a portfolio, while the stocks may or may not be similar, but the degree of holding can make a big variety. So first space that I see is that.
Sure.
The second space that I see, which is going to be more seasonal, we spoke about this earlier, which is the sectoral and thematic plays. Okay. But, Anupam, my true belief is that the big evolution and the big next wave, we're probably still far away from it, is going to be in the bundling.
Okay.
In the packaging, in how you're able to create, either customized portfolio of funds for investors, or talk to an investor and say, if this is what works for you, then look at this solution. Today, solutions have not been popular in India because of the attractiveness of returns that equity alone has given.
Sure.
This can't be the case always. And I think packaging will be a thing in the future, but of the future, for sure.
Very interesting. And what's happening at UTI AMC? What are you guys doing? Any new products or anything going forward?
Thankfully, things are, touch wood, God has been kind to all of us, and including at UTI. We pretty much have the entire suite of products. If I have to look at equity funds, the only one that we're probably missing is a multi-cap fund, a category introduced about a couple of years back. We will look at launching it. But we've done a fair amount of work in the passive space, in the smart beta passive space. We'll continue to bring value to investors over there. I think today, unfortunately, investors have ignored the fixed income mutual fund space completely because of the tax change that happened in the last budget. But I would again, urge investors to stick to asset allocation. And in that sense, again, at UTI, we've got the basket of fixed income funds, and then how do you bundle them together to create hybrid products? But I think we'd probably continue to focus on scale rather than just for the sake of, bringing out new products, keep innovating. Yeah. Unless and until it's a genuinely differentiated idea, which I'm not able to capture in any of my existing funds, we'll probably look at scaling existing products itself.
Nice. I wish you guys all the very best for that. Folks, the website, okay, last time when Vetri was here, I had said this and I'm saying it again that check out the UTI website for their monthly commentary. Not just what Vetri says, he has his own, I think, CIO section and he has his monthly newsletters, but a lot of their research and their insights are very, very useful for you to understand how the investment process works, how asset allocation works. So please do check that out. But that is it. Basically, our last question, which is standard question to all our guests who come in here: what book are you reading, and anything that you'd like to recommend to our list, to our audience? Sorry.
These are not books that I'm reading now. I have read them earlier,
Sure.
but whenever asked this question, I think for the new investor, I think there is a very simply written book called Rich Dad Poor Dad by
Sure.
Robert
Kiyosaki. Classic.
It's a fantastic book. Okay. I made sure my kids read it about 5 years back. Okay. And it just teaches you very good principles and the way you should be thinking. For the evolved investor wanting to get sharper and better, I think The Intelligent Investor by Benjamin Graham again remains a Bible decades and decades later. But from the field of finance, these are two things that I'd lay out there for investors to think about.
Can't go wrong with the classics: Rich Dad, Poor Dad, and Intelligent Investor. Folks, that is it. That's a wrap on this episode of PaisaVaisa. My guest, Peshotan Dastoor, Head of Sales, UTI AMC. Pesi, thank you so much for doing this for our audience.
Anupam, my absolute pleasure and my absolute honor to be the first salesperson to be in this couch here with you. Thank you so much.
Always happy to have you back. Thank you so much.
Thank you.